Hey guys, it's been a while since I made a video on my TFSA portfolio, and this is week 32 of the portfolio. So I'll be giving you the highlights over the past 3 weeks or so, just going over every single buy that I had in this portfolio. If you want right now, you can pause the video and just look over every single thing that I bought, or you can continue watching. So I received some dividends in the past 3 weeks. The first one was VFV. I got 27 cents from. Not much, but it's a dividend nonetheless. And I also got another dividend from AQN, $5.30. Then if we continue looking down at what I purchased, the first purchase I made was Air Canada, and I continue to buy into Air Canada just to dollar cost average down on my position. I think that over the long run, this portfolio is a 3 to 5 year portfolio. Air Canada should do decently well once the whole economy recovers. The fact that the government bailed out Air Canada effectively, I think that it's a bit too big to fail, even though it has before. But again, this is a bet that I'm having that Air Canada is able to pull itself up and out of this whole pandemic and eventually reward investors back. The stock, if we look at it right now on Google, we're still down from its all-time highs by about 50 to 60%. We're down 55%. So eventually, over the long run, I expect Air Canada to climb back up. Then we've got HXQ, which I bought a few times over the past 3 weeks. I bought 3 shares on 3 different occasions, below the $55 mark. So HXQ has actually been trending, or recently has been on a dip if we look at a stock chart. So its all-time highs over the past couple of months have been at around $56 per share. When I saw this dip, I started to buy into HXQ just to average down on my position. Next, again, I've been buying Shopify. You can see I bought Shopify about 4 times. One day I bought $50 worth just because it dipped below $1,700. And to me, for my current cost basis, at around $1,830, it was pretty much a steal. Shopify, again, is a long-term play, and it's always expensive, but the company continues to impress investors, and they continue to grow like crazy, especially during the pandemic. So I've been buying $25 here, $50 there. Next, I bought some shares of TELUS just because I didn't really know what else to spend my money on, and a lot of things were at all-time highs, so I decided to continue to increase my position in TELUS just to receive that juicy dividend. TELUS pays a dividend currently of 4.54%, and we might see some share price appreciation in the next couple of years with 5G rolling out. If we look at it historically, TELUS slowly climbs up, but it's a slow and sure sort of climb. So right now we saw TELUS breach its previous all-time highs, which were here around $27 per share. TELUS ended up hitting around $29 per share. So I think this company will continue to chug along, and the Canadian telecom space is fairly regulated. So it's very difficult for new entrants to come in and disrupt. I continue to buy some Well Health Technologies as long as it's under $7 per share. That's kind of the target I have set for myself right now. Well Health has been consolidating around the $7 range, even though the company continues to buy up companies and sell their shares to those companies for $9.80. So the fact that Well Health can continue to sell their shares for a price that's higher than what the market is paying, significantly higher actually, kind of shows me that the companies that they're buying, they do believe in Well Health over the long run, and they're okay with accepting shares at a higher price. And I would say Well Health shares are being sold at 30% or 50% more than what they're worth today. So again, I bought Well Health here, as well as somewhere over here, all below $6 or all below $7. Going down further, I bought 1 share of Enghouse. This stock, I'm just trying to keep this position up with the rest of my positions as this portfolio grows, and I paid $55.27. Lastly, I bought some fractional shares of VFV. I don't want to spend a full $100 on a share of VFV, which is why I'm using fractional shares. But I did see that VFV was on a dip. Its peak price was around $100 if we go over here to Google Finance. It peaked around 101, and we again had this dip here in early October. So this is when I was buying some more shares of VFV to average on my position. I was dollar cost averaging up. However, I'm not too worried about that just because the VFV is just tracking the index, and over time the index should go up. Otherwise, we're in big trouble. Jumping over to my portfolio metrics, we can see that my total market value of this portfolio is $8,654. And if you guys remember at the beginning of the series, I started this series off with $2,000 in this TFSA portfolio. And no, I didn't gain $6,600 from just pure gains. My pure gains are actually close to $400, or I'm up by 4.75 percentage points. Remember, every single week I'm averaging in and throwing in $200 per week. So yes, it adds up over time. It's slow and steady, but hey, we got here to $8,600. And if we're looking out a year from now, this portfolio could be somewhere around the $12,000 to $14,000 range. If we compare my portfolio against the index, basically every time I buy a position, I substitute it with the TSX index instead and calculate how much I'm up or down against that. So I'm actually down by about 3.33 percentage points. I'm not too worried about that. This is just more for me to track my investments and how well I do as an investor versus the index. And this is going to go up some days and it's going to be down some days, but over the long run, I'm hoping this number will stay green. Jumping over to my portfolio right now, we can see that my top position is TD. TD was a stock that I was buying around the $82 range when it had a drop due to its earnings recently. However, since then, we can see that the earnings effect has worn off, and they're currently sitting at $89.15. And the story I have here for you guys is that people like to sell on some bad news, but eventually the company, if it's a strong enough company, it will recover and be able to catch up with its peers. If you do the research, you can see that TD dropped when they released their earnings last quarter. However, most of the other banks either stayed flat or rose. And the fact that TD dropped, I think, just showed investors, if they were comparing against bank stocks, that TD was undervalued. So investors eventually saw that, bid the price up, and now we're sitting on a handsome gain of 7 percentage points. And this is over a period of 32 weeks, remember. On average, as an investor, you're hoping to get 6 to 7% return every single year. And if we look at TD here, I already got that 7% return on top of the dividend that I'm receiving at 3.54 percentage points. My second largest position is a Bitcoin ETF. And this is one that I was buying a little bit uncertainly when it was sitting around the $6 or $7 range. I started this position, I think, at around $8, and Bitcoin continued to fall. However, I did have faith that Bitcoin would eventually take off at the end of this year. Obviously, not enough to liquidate this entire portfolio and throw it into Bitcoin at $6 per share for this ETF. However, I did want to have a position in Bitcoin and wanted to test my theory out. So I made it a fairly significant position, and now it's grown by 44.96 percentage points. Subscribe down below if you want to see when I'm selling my Bitcoin position, because I will be doing that in the near future, hopefully somewhere around the end of this year. My third largest position is Power Corp Canada, and I've mentioned this time and time again. The net asset value per share should be around $50. If you look at this on the website, it says $50. And this is just them essentially adding up all their assets, what they're worth on the market right now, because they own other companies, and dividing it by the number of shares, and they get $50. Right now, the shares sit at $42, and they pay a juicy dividend of 4.23%. So not only are you getting this asset undervalued, you're also getting a pretty sweet dividend. In Power Corp of Canada, they own a significant portion in Wealthsimple, somewhere around 40 to 60%. I don't remember off the top of my head, but you can go search that up. Position number 4, I talked about earlier, Air Canada, and why I'm buying into that. You can see I'm down by about 10%. And speaking of losers, the other 3 losers I'm going to talk about in this portfolio again and again are Well Health, DCM, as well as GDMP. And these companies, I position them as relatively small positions in this portfolio just because of how risky they are. DCM is risky because of its price is very low and it's seen as a penny stock, but its business is fundamentally pretty good in my opinion. If we look at its market cap, this company sits at $44.8 million. Going over to Yahoo Finance, looking at the cash flow, how much money they're getting in the bank in the past year, they basically saw $46 million enter into their bank. And that's just their cash flow. Their operating activity was more impressive at $48 million. Now, the reason why investors didn't like this company before was because of their balance sheet. If we go over to the balance sheet, you can see their long-term debt. It was at $76 million. That's basically double the amount the company is worth today. However, if we go to the latest quarter, they paid that debt off handsomely. It's half of what it used to be. So this company, again, could have easily paid off their debt in the next 12 months based on how much cash flow they had in the previous 12 months, assuming that the business stays the same. So this stock is one to watch, and I think there's investors on the sideline looking to see if DCM is continuing to pay off the debt. We can see here they paid off another $5 million of their debt between these two quarters here. Lastly, just touching on GDMP. This position here is about 1.8% of this portfolio, so a very small portion of this portfolio. I'm down 25%. However, I think it's just because a lot of the company's hype was happening earlier this year with them being like a plant-based packaging company, and plant-based was all the rage. Over the long term, again, this portfolio I'm holding for 3 to 5 years. I will see where this goes with the 180 shares that I hold, and maybe we'll average down into this position a little bit more, but not too much more. That's pretty much it for this portfolio update. I do plan to add another stock soon, and that stock is D2L when they IPO. It's all dependent on how much hype there is around this IPO. If investors bid the stock price way too high, then I won't buy into it. But if it stays at a reasonable valuation, then be sure it will be added to this portfolio. If you want to see a deeper dive on D2L, subscribe down below because I'll have that coming out in the next week or so. I'll be throwing up 2 videos on the screen. If you're there, I'll see you there. If not, keep up the grind and have a great day.